Hello and welcome to the Portfolio Matters podcast, the weekly podcast for private investors. And yesterday we recorded the first half of our review of 2020, concentrating on the performance of our personal portfolios. And in this, the second part, we will be talking about the performance of individual asset classes. In the weekly updates going forwards, we will be going through a checklist at the start of each episode, looking at how individual assets have performed. And this aims to do the same for 2020 as a whole. But before we get going, I'm afraid we have to go through the disclaimer. Over to Richard.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. And let's get straight to it. The first asset we're going to be talking about is copper. Let me just bring up the table of assets. So you see that copper started the year at $2.80 a pound and finished it at $3.52, which is up 26% on the year, which is really quite remarkable given the fact that the world economy remains depressed. And if you look at the longer term picture, copper is now the highest it has been since 2012, i.e. it's now higher than it was throughout pretty much most of the last cycle, despite industrial production in certainly the developed world being below peak. And that presumably is on the back of Chinese stimulus. But the question must be, is this sustainable and how much of this is due to stockpiling?
So there are various numbers flying around, aren't they, trying to calculate what the future demand of copper is going to be in comparison to the current production levels. But as we discussed in the last podcast, trying to predict the actual demand in these circumstances where the price goes up, you have substitution and so forth, is very difficult indeed. It's clear that demand is going to increase with electrification of the world.
Yeah. I think we've both done quite a lot of reading about the long-term supply imbalance in copper. And copper, as you know, is essential to the energy transition. An aircraft has something like 200 kilometers of copper wiring, and the engine in a Tesla requires something like 25 kilograms. If we are going to electrify the world economy, then copper is the cheapest conducting material, and we're going to need an enormous amount of it. However, that is in the medium term. And right now, I think the market is anticipating a very fast transition into the new electrified world. And the question is, has it got ahead of itself? And I personally think in the short term it has.
It has. And then I guess the question is more over what time scale are you investing? If you are investing over a period of a few months, then you may determine that the time has come to exit your position. But if you're investing over 5 or 10 years, it may be you're very happy just to sit through the swings that are bound to occur.
That's true, Richard. But when I look at Antofagasta, which is the largest copper miner listed in the UK, and it's doubled over the course of the year, I think your entry point is crucial. And if you buy now at very elevated prices, then yes, if you're willing to sit on it for 5 years, you'll probably be okay. But will you make a good return? I think that's questionable.
One of the things that worries me about extractive industries generally is they're very vulnerable to taxation on, in inverted commas, super profits. And we know that world governments are going to be very short of cash and looking for places to raise additional taxation revenue. and the sort of windfall profit of a mining company due to rising commodity prices, but much lower input, much lower, smaller changes in input costs. It's just sitting there saying, please tax me, take it as a royalty, or however you like to phrase it. So I suspect that there is a sort of a maximum level of profitability that these companies can make before it starts to be taken away through taxation.
Good point. I think there's a lot to discuss about copper, and it will be a topic we return to during the year. So let's move on to iron ore. So the iron ore price started the year at $92 and moved up to 158.5, which is a 72% return on the year, and is absolutely extraordinary given what's going on with the world economy. So the iron ore price is now the highest it's been since 2011. So like copper, the iron ore price is now much higher than it was throughout most of the rest of the last cycle. And the one thing you know about iron is that the planet is made of 50.1% iron. There's no shortage of it, although in the Earth's crust it is less than that. But the planet itself is made in large part of iron. So there will be a supply response. So I personally think iron has gotten way too high.
Also, there's no particular increase in input costs for iron ore production. Energy prices are low rather than high. Labour prices haven't gone up. There may be some curtailment in production through COVID shutdowns. I don't really know. But as you earlier said, Keith, industrial manufacturing, heavy manufacturing is down, and there's whereas you can understand that there will be an incremental increase in demand for copper through the switch to electrification, I don't think the same is true for iron.
No, I completely agree. I think this is entirely Chinese stimulus. And if you look at what happened in the last cycle, in both the copper and iron spiked in the aftermath of the great financial crisis on Chinese stimulus, and then came off for the next few years. And I personally think that's exactly what's happening. Now, I have no idea whether it's going to peak tomorrow or in 3 months' time or in 6 months' time. But I think sometime over the next year, it will peak. And then you'll have a few years of drifting performance.
So just on that, I mean, there isn't a particularly relevant place to bring this in, but it is the question of inflation and commodity prices. And
yes,
a lot of people are saying commodity prices going up, inflation's on its way. And I don't think one necessarily follows the other, because I'm not convinced that a lot of these commodity prices are actually going to stick.
Well, I think that may be true, but then they've come up a long way, Richard. And if you are buying inputs for your factory on the spot market, then the cost of your inputs has just increased enormously, and particularly in the case of iron.
Yeah.
And also one thing we haven't covered and don't intend to cover is timber. But if you look at the price of timber in the US, it's absolutely shot up. And so people are talking about essentially the timber cost of putting up a wood framed in the house in the US having doubled over the course of the year. And that will feed into inflation. Yeah. Now, I suspect your question is really whether inflation will be sustained as opposed to there just being a surge in inflation, because all this points to a one-off surge in inflation.
Yeah, exactly. Yeah. I think that's what I'm saying. I'm referring, is there a surge which we'll see coming through, and then it will decline again when the commodity prices begin to drop back? Because if it is a speculative rise in prices, that's not sustainable over a long period of time.
I agree. But even if these prices were to reach this high level and then plateau, you will get a one-off surge in inflation. which will then dissipate.
Yes.
And if they go back down, then the obviously the inflation numbers will decline with them. But I don't think this increase in input prices will not lead to sustained inflation unless there's sustained inflation in input prices, which I just don't see.
Yeah.
So moving on to WTI, the American crude benchmark. It started the year at 61.6 and is now at 48.5, having obviously gone negative 40 in March. So it's down 20.2% on the year. And the thing I'd say about the oil market is it's an entirely artificial market, in that the OPEC Plus have taken 7.7 million barrels a day out of the market.
Yeah.
And essentially they now control where the price is. So the only thing to say about that is, unless you can predict what OPEC Plus are going to do, you can't really predict what the oil price is going to do. The one thing I would say is that I question how much OPEC have actually taken out. Now, they claim to have taken out 7.7 million barrels, but if you look at the average they're producing now and the average they're producing at the end of last year, before they artificially boosted production in this price war between Saudi and Russia, and Saudi started selling oil from storage, then they're down about 5.5 million barrels, not 7.7. But that's still a hell of a lot. Yeah. And clearly, if they were to flood the market tomorrow, the price would probably decline to zero again.
So I guess obviously there's the competitive position of each of the component countries of the OPEC cartel, and the incentive to go their own way versus the disincentive of, if they all do that, the price of oil drops. But if we are heading into one last oil price cycle, as you believe,
yes, then
they want to make it a good one. Because if you look at the finances of Saudi Arabia, it's highly dependent on oil. If it feels this is its last chance, it will want to make the most of it, surely.
The thing is, Richard, I think the reality is we will need oil for a very long time. And when you look at the investment environment, the Western world is rapidly moving to an ESG emphasis.
Yeah.
And it could well be that they starve the Western oil companies of capital, in which case the survivors will be Russia, who really don't care about ESG, and the national producers, such as Saudi Arabia. So how much do Saudi care about the short term? Obviously, they want to keep the oil price high and are willing to sacrifice market share to do so. But are they really worried longer term? I suspect probably not, actually. I think this ESG emphasis probably plays into their hands, rather like the Western governments banning the sale of cigarettes, banning tobacco, putting very high taxes on them, actually resulted in tobacco companies having 25 years of quite extraordinary performance, because essentially it banned all their competitors.
Yeah, interesting. What's next on the list, Keith?
Next on the list is gold, our favourite asset. Am I sharing that, Richard?
No, not at the moment, Keith.
No, right. Okay, well, let me have another go at. Okay, gold. So gold started the year at just over $1,500 and is up 25% on the year, which is an extraordinary performance. Although if you look back at the long-term performance of gold since Nixon took us off the gold standard at $32 in 1972, its annual performance has been absolutely extraordinary. So from $32, it's now at $1,900.
So it's been a very volatile path that it's followed, but had you just bought it and held it, you'd probably done as well as in any other investment, wouldn't you?
Absolutely, you've done far better than the stock market, frankly. And
the moral of the story then is invest in the long term, but pick the right asset.
Well, exactly. And the thing is, what I would say is when you look at the cycles in the gold price, when gold does badly is when the market feels that central banks are in control of money. So when Volcker came in and put interest rates up to 15% in America, suddenly gold lost a lot of its appeal. And it had a very bad, couple of decades, actually.
Yeah.
Whereas right now, you can't feel that they are in control. They are printing money like it's going out of fashion. When we get to the the forecast for 2021, we have some charts about the increase in central banks' balance sheets, which are really quite extraordinary and frankly frightening. So I think that gold should be an essential part of everyone's portfolio at this point. And I know, Richard, you've actually put that into action.
I would agree, as have you, Keith, yes.
So moving on to the all share. So if we look at the performance of the other stock markets of the world, you'll see that the FTSE is the worst performer amongst developed markets. And there are only two markets which had negative performance on the year, which are the UK's FTSE all share and the 100 and the CAC 40 in France. Every other major market was up. The standout performer was the NASDAQ, which is up an absolutely extraordinary 44% in a year in which the world economy is down. And I think that also tells us part of the reason why the all share is down, in that we have relatively few technology stocks. So Richard, how would you like to talk about Bitcoin?
Well, I think we talked about it a lot yesterday, Keith. So yeah, I don't think there's much more to say on it, other than it is very volatile. If you do have it, it should be a small proportion of your portfolio. And I also think if you do have it, you should say, I'm going to hold it for 5 or 10 years. I don't think you should try and trade it.
Right. Okay, moving on to the S&P 500, which was up 16% on the year, in part because of technology stocks. But also, I think when you look at the amount of stimulus the US has done and the way they have put checks into households, then people in the US are stuck at home and actually their savings have gone up. And so what you see is a lot of day traders playing around in financial markets because they have the money and the time. And if you look at retail buying of options, it's exploded. So whether the current bull market can be sustained, and if so, for how long, is an open question, which we will return to in more detail tomorrow.
Okay, I think there's quite a lot we can talk about there tomorrow.
Yeah, okay, so the next asset up is the US is sterling, which actually was up on the year. I think mainly because we had a Brexit result.
Yeah.
But the costs of Brexit will play out as reality sinks in.
Sterling is up somewhere between 15 and 20% since the low of the Brexit vote, isn't it?
Yes. Yes, but going forward, I would be concerned that there's a lot of anticipation that we will be okay, but we don't know until actually the new border arrangements are in, you will have noticed that yesterday was the first trading day of the year, and essentially all European trading left the UK.
Yes, I saw
so
that.
That is one of our exports. Financial services has just disappeared in a flash. Okay, so looking at base rates and yields, you will see that everything collapsed. So the UK base rate started the year at 0.75% and ended it at 0.1%. And I think the key takeaway here is that there's no further room to cut on the short end. And the long end, rates are very depressed, and buying bonds at these levels, I think, is a very bad asymmetric trade, in that rates can't go much lower, but they could go much higher. So if inflation does pick up, as Richard discussed slightly earlier, then you should expect to see big movements and downward movements in the prices of long-dated gilts.
Yeah, I mean, the long-dated gilt is the classic return-free risk, isn't it?
Precisely.
And you know, in some senses, the risk is you don't get any of your money back as well, because of the default risk. Although that's that's quite a long way out, I guess. That's why I don't wish to sound apocalyptic.
Well, I think if you buy government bonds, you are going to get the money back, but you're going to get paper money back.
Yes. Exactly.
And what that's going to be worth is an open question.
Yeah. Although, interestingly, just before we move on, Keith, there has been some discussion recently, I think, that we've seen about this concept of governments, issuing perpetual zero coupon or very low coupon bonds that effectively are bought by the central bank. Yes. and are never redeemed. And what does that do to the money of an economy? I don't know.
Well, I'd say that's exactly the same as money. That's what money is.
It's pound notes.
Pound notes.
Yeah.
So essentially what you're doing is you're just printing money to pay for government services.
Yes, and your seniorage is coming through UK gilts in this case, if they did it, as opposed to £20 notes.
Absolutely. So the last item on these charts are the UK inflation rates, which are very depressed because you can't actually go out and spend anything. So demand is very low. Now, I would push back on these numbers in that my experience of inflation, and the few times I've been allowed to go to the pub, is that inflation in service industry and restaurants and pubs has been absolutely extraordinary. A pint of beer in Hampstead in London is now £6.50 plus 10% service charge, because you have to sit out in the cold and wait to be served. And so you're talking about probably 20 or 30% inflation over the course of the year in beer and the price of pub food. Now, that may be a very small part of the basket, the inflation basket, but it's quite a large part of the way people perceive inflation. And I think there's a gap opening up between experienced inflation and measured inflation. So the next item to discuss is within the UK equity market, what sectors did well and what sectors did badly. So the best performing sectors in the UK were, as you might expect, leisure goods. With everyone stuck at home, the board games, actually the thing about leisure goods actually is this FTSE sector consists of two stocks, one of which is Games Workshop, which had an absolutely extraordinary year. So how investable the leisure goods sector is questionable.
Yeah.
But industrial metals and mining was the next best performing sector, which, as we've discussed, iron and copper were extraordinary investments during the year. despite the fact that in economic activity is depressed, and there seems to be a big disconnect between financial assets, which are, and I'm including copper amongst that, and the real economy.
Yeah.
Technology, hardware and equipment, and electrical equipment, electronic equipment. I mean, if there's no growth, people pay up for growth. So technology stocks have had an absolutely extraordinary year. A stock will probably be returning to regularly throughout the year is Tesla, which is the epitome of technology bubbleism and over optimism. It now has a market cap which is greater than every other car manufacturer combined, despite only producing 500,000 cars. So I think that if we do get a return to economic growth and inflation, then you should see a tilt away from growth stocks, technology stocks, towards value stocks. And that is something I would be anticipating going forward. So the next big section performer was equity investment instruments. And when we looked at the last table, it showed the performance of world markets. There are loads of investment trusts listed in London, and in aggregate they did well, up 15%. Basic materials, again, did very well, where we're talking about iron and also house building aggregates. Now the other sector that I wanted to discuss was electricity, which alone amongst the utilities listed in London did very well. And that all turns out to be due to the electricity producer Drax, which had it has an enormous, used to be coal-fired power station, which it has switched to burning imported wood pellets.
Right.
And it now ticks the boxes for ESG. Now, how ESG it is to import in huge diesel-powered tankers enormous tons of wood pellets from America is open to question. But the reality is that the fact it ticks all the ESG boxes means that there's a wall of money flowing into it, and the shares have done extraordinarily well, more than doubled since their lows in the year.
I mean, you have to think, don't you, that any electricity generating facility that burns something, unless it's rubbish, is doomed. Fundamentally.
Well, if it's burning wood pellets, which are meant to be, you're part of the carbon cycle, aren't you? It's carbon neutral.
Well, you are, but on the other hand, if you want to tank a load of tanker or whatever it might be, load of wood pellets, you don't sort of trip across those by accident, do you? There's a huge industry which is creating wood pellets, and I take your point about it being carbon.
I completely agree with you, but those they're going to be powered across the ocean by ferries, Richard.
Superficially carbon neutral, Keith.
Yes, well, exactly. So nobody counts the oil cost of cutting down all the trees, transporting them, etc., moving the wood pellets by their many millions of tons across the ocean. Anyway, moving on to the worst performers. The worst performers are no surprise at all. They're oil and gas producers, of which I hold quite a number. So let's move on from that. We've discussed them and move on to banks. Now, if you believe that the UK economy is going to recover strongly, then surely banks should be a great investment. They should be geared to GDP growth. Now, the fact that banks have performed so poorly, I think, indicates that the market doesn't believe that we will have a strong recovery.
I think also banks must be affected by people's fears about bad debts and bad debt provisioning as a result of COVID, and the uncertainty relating to what the ultimate loan loss provisions need to be.
I agree with all that. But the reality is, when you look at people's incomes have actually held up extraordinarily well. They have savings. Now, there is a distributional problem, so that the rich have done quite well this year, but the poor who have been put out of work or furloughed have done less well. But and the other thing I want to say is that banks generally make their money by borrowing short from depositors and paying them short-term interest rates and lending long. And so they make money on the spread between short-term interest rates and long-term interest rates. And while long-term interest rates are depressed, and we saw in the previous table how long bond yields were at historic lows, that means bank profitability is low. But if we believe that inflation is returning, then long bond yields should rise, which should be good for the banks.
So one of the interesting investment strategies is to invest in the last year's worst performers, isn't it?
Yes.
And so if one were to follow that, you buy an oil and gas producers ETF, oil equipment distribution, banks, fixed line communications, and aerospace and defense ETF, and sit back and watch your profits roll in, Keith.
Haha. Well, I'm not sure that would be such a bad strategy, actually. I mean, when we look at aerospace and defense, I mean, presumably most of that is Rolls-Royce and other related aerospace companies. And obviously, as international air travel has collapsed, so the sales of these companies has collapsed as well. I mean, the rest of this chart, most of it, I think you would say was fairly obvious, like leisure and travel. Of course, nobody can travel, so they're down 20%, which includes a great recovery from the lows. Tobacco.
We should run a small portfolio of the bottom 5 or so, and just monitor it during the course of the year.
Absolutely. Well, I think we will see a lot of sectorial shifting during the year. Now, I thought the fact that fixed line communications has been such a bad performer was interesting, in that you would think that was quite defensive. But actually, I think what's going on there is that BT has got huge amounts of debt. All these old technology companies have, they are on the way out. They're old technology, and actually they've been declining for many years, and nobody wants to invest in them. They're not the future.
So I would just come back to you on that one, Keith, by saying that I have a small position in BT because I'm experimenting with Elliott wave analysis, and I looked at the BT share price and I thought, this looks like one to try out. So in one of our next podcasts, I'll bring up the graph of BT, explain why I think I'm an amateur at Elliott wave analysis. Probably amateur is putting it too strongly. I'm a novice, and just talk it through, and so we'll see. So I think that BT is on fire and is no, I don't.
Well, great. I'm really looking forward to this, Richard. So because we really need to have some diversification in our portfolios, have something to talk about. So the fact you are you've got some Bitcoin, and dabbling is the word I was looking for, dabbling in Bitcoin and in Elliott wave analysis, I think will be very entertaining for the coming year.
And you're dabbling in oil, Keith. So.
Well, I think I'm more than dabbling. Actually, I might be swimming in oil. But actually, for my own part, I intend to open a small short in Tesla at some stage.
Do you really?
I do.
That will be
Because
very interesting.
It offends me. But I have, at some stage, I will do for my worst trade, my worst ever trade, which was a short sale. And I've largely sworn off doing them. So this will just be essentially as an experiment. And one of the things I will be very interested in calculating as I do my short in Tesla is what are the costs, because my experience previously was that the costs in terms of the daily financing fees were non-trivial and very annoying. So every day it was going nowhere. Your broker was making money out of you.
I also think that if one's going to try this sort of thing out, you really need to do it with real money, even if it's only a small amount.
Yes.
A little bit of skin in the game, and then if it works, you feel good. If it doesn't work, you feel bad, and you actually experience the emotions of it not being right. So that would be very interesting.
Well, we will see. Now, I'm not doing it just yet.
Out of it, Keith.
So I say that again?
I look forward to you making a fortune out of it. Enough to be able to buy a Tesla.
Yes, so do I.
I bought this out of my pockets of shorting the company.
Well, of course, the trouble with shorting is the most you can make is par. So if you short £100, the most you can make is £100. Whereas if you're long, you can make, it can go up 20-fold. And of course, if you're short, you can go up against you 20-fold.
I thought you were going to short it using options, Keith.
Yeah, no, I don't understand options. And also, in the case of Tesla, the volatility is such that I suspect the options must be incredibly expensive.
Very expensive, yeah.
But Tesla shorts have had an absolutely appalling year in that Tesla share price is up 6-fold. So anyway, we will cover that in a future episode as I dive into the world of shorting with Tesla. Anyway, so the final thing I wanted to talk about when we discussed last year, and it's something we discussed briefly in yesterday's podcast, talking about our portfolio performance over the year, was what caused the crash in March. And if I share the screen, okay, so here we have a chart showing the equity fund flows. So the question is, was the sell-off in March caused by private investors panicking? And traditionally, the view is that private investors always tend to sell at the bottom and buy at the top because they're very emotional. And actually, I don't think you can say that. If you look at the equity fund flows, then it's very difficult to distinguish March from any other month of the year. There were net outflows from mutual funds and tiny, very small net outflows from equity ETFs. Now, the SEC have slightly more granular data, and they do show some equity outflows in March, but they are really not that large. So I think what caused the sell-off in March was deleveraging by institutions. So I have a friend who runs a long-short portfolio and has written into the fund description, it's a UCITS fund, he's written into the fund description a VAR level. And when volatility spiked in March, compliance came round and told him his VAR was now too high and he had to reduce positions. So then he was then forced to sell his most liquid stocks at the bottom of the market.
So Keith, can you just explain how VAR is calculated?
So VAR is short for value at risk. So what you're doing is you're looking at the historic volatility of all your holdings. And obviously there's various interpretations of ways you can do this. And you're saying, based on historic volatility, how much risk am I taking with this portfolio over months and years? And obviously there are nuances in how you do that. If you take the volatility of an asset like, let's say, BP over the last 20 years, and your measurement window is 20-year period, then the daily performance of BP over the last month is really not going to change your VAR at all. But clearly what's going on is that they're not using a static long-term calculation of VAR. They're using a dynamic calculation of VAR, which is affected by daily changes. And that means as volatility spikes, so they have to reduce risk. And when we discussed yesterday the goings on in the US Treasury market, which resulted in the market completely seizing up during March. And bear in mind, the US Treasury market is the most liquid market in the world. And suddenly, little old me couldn't sell his small position, which is quite extraordinary. I think what we're seeing is that there's a lot of volatility, there's a lot of leverage, and there's very little liquidity when you need it. Liquidity disappears, and that exacerbates volatility. So you have forced sellers and vanishing liquidity, leading to very sharp drawdowns. And if I have any prediction for the coming year, it's more volatility. We have extraordinary levels of debt, and that means the equity portion of the balance sheet is very dependent on changes in market conditions. And so as we have more debt, we should expect more volatility. Since the great financial crisis, banks have a great deal of new regulations which limit how much they can put on limit the size of their balance sheet. So they are not stepping in to provide liquidity. Liquidity is being provided by algorithms which step out of the market when they see a very strong trend developing. So when we look at the behavior of private investors earlier in the year, they don't seem to have really sold many equities. So what did they do? Well, actually what they did was they sold bonds. Now, let me share this screen again, and you'll see that there were extraordinary bond outflows in March. Mm-hmm. So private investors were very sensibly liquidating their bond portfolios, with bond prices having spiked because interest rates were low and bonds were safe haven, and central banks were buying government bonds and using the proceeds to buy equities. So if we look at the more granular data from the SEC, you'll see there were large outflows from bond mutual funds, which were completely uncharacteristic of the market. Mm. So that leads on to the observation that I think a lot of private investors have actually done better than the professionals this year because they bought in March.
Yeah, interesting. And yet private investors are called the dumb money and professional investors are called smart money.
Well, I think that the professional investors may now have wrap themselves in so much red tape that when volatility spikes, they are forced to liquidate into falling markets.
Yeah.
Right, well, I think that's been a fairly comprehensive coverage. Actually, no, it's not, because there is one more thing I wanted to discuss,
Right.
and that is we had one of the things we have been investing in recently and has been a big theme now and going forward is clean tech. So how have the clean tech metals done? And I have a chart here of the performance of a few key clean tech metals. So these are the metals that are going to be needed either in battery chemistry, so cobalt, nickel, lithium, manganese, apparently, and vanadium, or in magnets. So that's praseodymium and neodymium, both of which are used in the Tesla's electric motors, and 200 kilograms of which are in the average wind turbine. And what you can see is that cobalt is down on the year, lithium is down 6% on the year. And if we think that lithium production is going to treble over the next 5 years, and that lithium prices are already well down from their highs of 5 years ago, I really wonder whether we aren't seeing the beginning of a glut in lithium. And the performance of lithium metal is completely divorced from the performance of lithium miners, which have had an extraordinarily positive year. So I think there's this gap opening up between the performance of ESG stocks and the underlying fundamentals.
Yeah. Particularly, not so much necessarily so much with the rare earths, because the rare earths are also tied up in geopolitics.
Yes.
In that China produces 80 to 90% of them, and countries, including the United States, wish to make themselves less dependent upon Chinese rare earths for what is a strategically important mineral, or minerals. So the rare earths are a different kettle of fish, I think, to lithium, which is widely available on the surface of the earth,
Yes.
and mined or collected in multiple different countries. And also, interestingly, cobalt did go through a very significant price rise, I think, over the last couple of years, obviously not the last year, just gone. And one of the things that's happened as a consequence of that is it's being removed from batteries because it's too expensive and substituted.
Yes.
And so the demand for cobalt is dropping, and this is the classic substitution problem that you get with these big price rises.
The other thing I'd say is nickel. So nickel has had a good year, it's up 19% roughly. But it is also divorced from its fundamentals. So if you look into the fundamentals of the nickel market, they're now forecasting a glut over the next 5 years.
Right.
So nickel is very important in battery chemistry, but there's a real disconnect between the fundamentals of the market and the price currently, which I don't think is sustainable going forward. The other thing I'd say about this chart, this table, sorry, is have you noticed how some of the prices are quoted in Chinese yuan? Because that's where the center of the market is.
Yeah.
It's not in the West anymore, it's in China. Okay, right, and then with that, I think we are done. And so thank you for listening. I hope you will join us for our next video, which will be our forecast for the year 2021. If you've enjoyed this, I hope you will press subscribe and like so that we can try and find a wider audience. I hope you will join us again tomorrow for our discussion of our predictions for the coming investment year, and on a regular basis throughout the year as we do our weekly podcasts. If you've enjoyed it, please can you press like and subscribe to the channel so that we can try to find a wider audience. And we hope to see you again tomorrow.
So it's goodbye from Keith Jordan.
It's goodbye from Richard Wheater.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.